For today's investment advice from legendary investor Warren Buffett, we'll be taking a look at his 1994 letter to shareholders. Warren laments the fact that Berkshire Hathaway has grown to $11.9 billion from $22 million when Warren and his business partner, Charlie Munger, took over management. Of course, today, Berkshire Hathaway is worth a lot more than $22 billion. At the time of writing, Berkshire Hathaway is worth over $400 billion. Now, why would Warren Buffett be lamenting the fact that Berkshire Hathaway has grown so much by 1994? Isn't it the dream of many CEOs to be at the helm of a multi-billion-dollar business empire? Well, for Warren Buffett, given the size of Berkshire Hathaway, any business acquisition he makes has to be of a certain size in order to have a material impact on Berkshire Hathaway's bottom lines. A $1 million deal might be significant when Berkshire Hathaway was worth just $22 million, but insignificant for an $11 billion company. In 1994, Warren set $100 million as the minimum deal size to warrant consideration for Berkshire Hathaway. Warren Buffett spells out his investment dilemma. A fat wallet, however, is the enemy of superior investment results. Though there are as many good businesses as ever, it is useless for us to make purchases that are inconsequential in relation to Berkshire's capital. We now consider a security for purchase only if we believe we can deploy at least $100 million in it. Given that minimum, Berkshire's investment universe has shrunk dramatically. Now, given these constraints, it's easy to waver, to bend one's investing standards and strategy for the thrill of the deal. In Warren's 1995 letter to shareholders, Warren points to an interview that business thinker Peter Drucker conducted for Time magazine, which describes the thrill of the deal. I will tell you a secret. Deal making beats working. Deal making is exciting and fun, and working is grubby. Running anything is primarily an enormous amount of grubby detail work. Deal making is romantic, sexy. And it's not just a constraint of size. It's tempting to bend and rationalize why it makes sense to make an investment that deviates from your original investment plan and philosophy. The mind is very adept at rationalizing the irrational when it wants something, even when it's harmful. Warren Buffett describes this scene. Some years back, a CEO friend of mine, in jest it must be said, unintentionally described the pathology of many big deals. This friend who ran a property casualty insurer was explaining to his directors why he wanted to acquire a certain life insurance company. After droning rather persuasively through the economics and strategic rationale for the acquisition, he abruptly abandoned the script. With an impish look, he simply said, "Ah, fellows, all the other kids have one." Some CEOs go through a kingdom-building phase and seek to expand their financial holdings, irregardless if the business deals make sense or not. Warren points out, many CEOs attain their position in part because they possess an abundance of animal spirits and ego. If an executive is heavily endowed with these qualities, which it should be acknowledged sometimes have their advantages, they won't disappear when he reaches the top. During the late 1960s and early 1970s, many companies were merging and acquiring a host of different companies into conglomerate mania, in the names of diversification, synergy, and the new science of corporate management. Many of these conglomerates would later break up, piece by piece. Warren Buffett warns against this, to bend one's investing philosophy, which in Warren's case, we believe that our formula, the purchase at sensible prices of businesses that have good underlying economics and are run by honest and able people, is certain to produce a reasonable success. Rather than give in to the itch of deal-making or investing for investing's sakes, stick to your original investment game plan to wait for the ideal pitch before you take a swing. Some investors get antsy when they have money sitting in their bank account. They want to put their money into action, to invest in something, in anything. Speaking personally, I know this feeling all too well. You want to see your money invested in something, to see the numbers rise and fall, to watch your screen light up with activity, to have some sort of action. It's not very exciting to watch your money sitting in a savings or checking account. But these are dangerous moments that frequently results in buyer's remorse, just like going to the mall looking for something to buy rather than needing something and going to the mall to purchase it. Once again, Warren warns against listening to political and economic commentary that might sway you from your investing strategy. As Warren points out, 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bills yields fluctuating between 2.8% and 17.4%. There will be many factors, both externally and internally, that will try to sway you from your investing plan or strategy. The thrill of the deal, the fear of trade wars, inflation, deflation, and war, to name just a few. Speaking personally once again, it seems like I can't go anywhere without the specter of fear looming over me. Political unrest, economic malaise, drug epidemics, global health epidemics, bribery and corruption, the 24-hour news cycle never ends. However, to invest is to a degree to be optimistic in the future, and as Warren points out, imagine the cost to us then, if we had let fear of unknowns cause us to defer or alter the deployment of capital. Indeed, we have usually made our best purchases when apprehension about some macro event were at a peak. Fear is the foe of the faddist, but the friend of the fundamentalist. A different set of major shocks is sure to occur in the next 30 years. We will neither try to predict these nor to profit from them. If we can identify businesses similar to those we have purchased in the past, external surprises will have little effect on our long-term results. Thanks for watching. I hope you learned something from Warren Buffett's letter to shareholders. Please like and subscribe to the Strange World of Econ channel. It's a great free way to support the channel so I can bring you more investing advice from legendary investors. Till next time.